everybody. This is Mortgage Post 411. I'm Audrey Boissonou with my co-host Kevin Casey, and we are joined today by the amazing Bill Dallas with, what is that? Dallas Capital? Oh, Capital. That's it. How are you doing this morning, Bill?
Good. How you guys? Nice to see you, and thanks for having me back on.
Oh my God, we love you. You know
Pleasure.
what? I love
great time
people
last time.
who just say it like they think it is, and that would be Bill Dallas. So, but before we take a dive, I just want to say that we have a few NMLS classes coming up, don't we? Because we're all getting nasty grams saying, you haven't done your NMLS yet. You haven't done your NMLS yet. So make sure you get it scheduled. And if you should desire a live experience, Kevin and I will be teaching August 24th in Daly City at this gorgeous golf club. Beautiful, beautiful, beautiful. And then in September, on September 22nd in Thousand Oaks, those are both put on, that's one's by San Francisco Camp and the other one is Greater Ventura Camp. Yep. So that'll be good. Yeah.
And we have another one the following Monday after that one, back up in Sausalito.
God, that is so, have you been to Sausalito, Bill?
You bet.
Oh my God, we do it at the Sausalito Yacht Club. So your view is the San Francisco Bay. It's the most glorious
right on
place.
the water.
Oh my God, it's great.
Downtown San Francisco.
Yeah, you sit outside when you eat your lunch. We do take a little lunch break there because everyone wants to go outside and sit on the deck. It's just glorious. Okay, so if you missed last week, you are totally SOL. You can ask your teenager what that means if you need to. We had Mark McCardle with the CFPB on, and we can't post the recordings, but he was great. And also, if you have never gone to our YouTube channel, you should. I was telling Bill, I finally for the first time went and listened to one of our recordings because I wanted to hear it, and I did it on 1.5 speed. It was hysterical, actually, but it was also really good because first you can knock it out much faster, but also it's a lot of good content, for God's sake. I'm like, okay, I'm not making this crap up in my head. So just a quick recap of what Mark McCardle with the CFPB said last week, and make sure when he's on, you show up live because we can't post them. Okay, so we talked about trigger leads, right? They are working on it. It is in their crosshairs. We talked about the fact that we have a friend whose borrower literally went to the emergency room because they got so many trigger leads and anxiety attack and ended up in the hospital, for goodness sake. That's ridiculous. And Kevin,
but the CFPB is going after them on making offers.
It's not a bona fide offer of credit.
Yeah.
Right, exactly. So they're working on it. Kevin suggested that they move the companies that are doing the trigger leads improperly up the audit list, which was a great idea. We talked a lot about the Supreme Court and what's coming up with that and what would happen if that ruling was ruled, or if they were ruled unconstitutional. A reminder that Dodd-Frank is still there. So literally it would have to go back to Congress. I mean, it's not something we really want to wish for. It would be a complete cluster from what we could tell.
But what we did figure out, though, that was neither the Democrats or the Republicans have a contingency plan. No.
Oh yeah. Kevin suggested, he's like, oh yeah, I'm sure they're working on that now, right? And being proactive. Yeah, that would be a big no, people. It would be a major cluster. So anyway, we talked about mortgage complaints being down. They're really focused on student loan debt. They are, they've revised the servicing rules, or they are revising the servicing rules. They're focused on non-banks being solvent. And buybacks, they're aware of those with the GSEs and that's a problem. And AVMs, homeowners insurance, monopolies, and the fees work number, which Bill doesn't think the fees are as big of a deal as I do. So we can talk about that in a minute. So Bill, we had a fairly substantial list of things to discuss today. So let's get to it, shall we?
Let's do it.
All right. So everyone is making money hand over fist. Oh, wait. No. Just Fannie Mae is making money hand over fist. Let's talk about that for a minute, because it's one of my pet peeves. While we are all like sucking wind and trying to survive in this crazy market, Fannie Mae reported solid Q2 performance. They had a net income of how many billion? $5 billion with the B dollars. That's right. So this doesn't make me happy, especially since cost to produce a loan is like front and center on Bill's to-do list on things that we need to address as an industry. So they're making $1 zillion and we are not.
No, that's
What do we
billions, not zillions.
Oh, I'm sorry. Sorry. Billions, not zillions. What do we need to do, Bill? Cost to produce is out of control. Thoughts?
Yeah, I mean, you've hit a nail that's been, that contractors have been trying to bang for years, right? How do you create a market for institutionalizing mortgages and yet have the government provide what it does, its guarantees? Because like you and I talked, really, if you look at the private market could probably do everything that we need, except in times of tragedy, right? When you see COVID, when you see fires, wars, droughts, hurricanes, floods, all those things, right? So I think the convolution of that is that because we are, and all of us, brokers, bankers, originators, banks, independent mortgage banks, because we're all connected to this market where a 30-year fixed rate loan is the institutional loan of America, right? And if you try to get outside of that, it's very hard. So agency, which we broadly would call, I mean, in that case, it's FHFA, it's Fannie Freddie. But if you throw Ginnie Mae in there, Ginnie Mae is actually owned by the federal government, whereas the other two are sort of not, right? I think what you've got really is a government run industry and a government business. And that's why our cost per produce so high. That's why the one product, a 30-year fixed rate loan, has 500 different underwriting guidelines. And that's why we all suffer, right? Yep. To some extent. So it's a blessing in times of trouble, and it's a curse when you want to innovate it, right? Because it's in triplicate. You just had the CFPB on. I mean, we invented the CFPB. Okay, well, that invented intent to produce, and that invented from Dodd-Frank all your comp plans. That invented a change of circumstance on every loan, and you have to redisclose on every loan. That invented, massive amount of confusion and compensation. And so what does that do? That increases the cost to produce by a gargantuan number, because you need, if 80% of your cost, and I know we differ a little bit, but if 80% of your costs in mortgage business is in people, then where you see them is in input, disclosure, appraisal, LOAs, processors, underwriters. And suddenly we're doing, loan officers are doing 1 to 2 loans a month. So why in God's name do I need to be digital? I mean, we could actually build a tomb this way. You and I could carry our one loan and plug it into something. And why do I need an LOA? What? To help me take my one loan and carry it up and put it beside the other one? So I think it needs to be thought out. And when you hear the words technology or fintech or all those things, I mean, I've tried in my lifetime to modernize this, and it's a business that wants to be analog, and it wants to be in triplicate. And the guidelines haven't changed in 1,000 years.
Yeah.
Right.
So we might as well underwrite a pterodactyl, right? Because at the end of the day, a consumer does no longer sees themselves in any of our income guidelines.
Right.
No longer. I mean,
yes.
So you and I could spend forever trying to figure out how to underwrite your base income. Okay, I have 3 jobs. I have this, I'm a writer, I have my podcast, I actually work at this job function, my wife or my spouse does this, right? And then I got income coming from rentals. Well, I can't count any of that shit.
Yep. Oh, wait, I got some royalties coming in too.
Yeah. So all of that, so that just got me started a little bit, right? With what do we do with, and why do they make money? Because they are the institutional, if you think about, they securitize on our behalf every loan in America, or 90% of the loans.
Yeah. So you had made the point that it takes there are 2 non-producing people for every producing person in the industry. So we are very people heavy, no matter which way you cut it. And the only thing that I had heard, and I need to go back and double check these numbers, is that the tech costs have driven our costs up a lot. And a lot of tech we're not even using. And so we need to take a strong look at that. I need, I have been doing that in my own business. What do I sign up for? What am I actually using? What does it cost? Is there an ROI? And this is something that every time we talk to the CFPB or any government entity, we keep saying there needs to be an analysis of ROI before you force an entire industry to implement something new. So that goes for a form, a credit reporting way of
look
doing
at take them all, if you really think of the simplicity of this, right? I basically have title. I need to check title. I need to check credit. I need to check value. I need to check income, and I need to check assets. That's it.
Yep.
All right.
Yep.
I go after assets. I rest my case. I bet you, given the guidelines and the interpretation of the guidelines, I can't count half of them. Or you didn't get it, or when did you get it, or how much is it, or how much do I have, and who calculates it? If I go income, oh God, don't get me started. Can't count any of it, right? I can't count your bonus. I can't count overtime. If you ever show me your tax returns, you're sort of hosed. Yep. What about bank statements? What about, now I've got DSCR and I've got rental income. Oh, I'm sorry, I can't count any of that either. Okay, well, let's go to valuation. Okay, how shitty can one thing be?
Yeah.
It's so simple. The house sits there, and Fannie Mae and Freddie Mac probably have a repeat transaction index that they probably have since 1979. And they could probably tell you what that house is sold for 27 times. So why am I appraising it?
Well, I think, okay, so they were talking about, so AVMs have been a hot topic for the last few years, right? And
forever.
Last week, our friend Mark McCardle said that they actually issued a rule on June 1st about AVMs and what goes into them. And I had told him, I said, I've read white papers on this. I had no idea how much goes into an AVM and how different they can be based on humans. So it's still human.
The values there either.
It's still humans, so I just find the whole thing interesting.
It's thousands and thousands of dollars. It's reappraisals. It's checking the appraisal. It is a second appraisal. It could be, and you've got to get access to the property. You got to have all those things. And I'm telling you, in most cases, right? New construction, why are we even doing? If you got 300 of them coming, right? Why don't I not have one appraisal on 300 or 5 styles or whatever that's going to be? So I think the waterfall part of it is just another reason why, right? We have to give you a copy of the appraisal. I have to give you a disclosure of intent to proceed. I've got to give you all these different things. And then you move to credit, and then you move to the application. The application suddenly has become, the application was built for a primary occupant,
right,
and a spouse. So when we built Cloudvirga initially, one of the biggest conundrums of what do we do with multiple occupant co-borrowers? Even if they're unmarried, married, family, unfamily, and you've got to give everybody privacy.
Yep.
And you've got to keep their information secure. And you've got to have them to have individual information. All of that complication has never been thought out really in a way in mortgage, right? Especially post 2006, 7, and 8. So all of these laws, including the CFPB, have all come in. So you've got this layer of compliance and just a layer of cost that have made this a really ugly process. And that's, look at the cost produced, $2,000 in 2000, $16,000, $15,000 today.
Yep.
Right. And we're doing volume of loans, right?
Yeah. We're not making it up on volume.
Right.
And we have too many people in the system. We have too many people in as LOs. like in my little county in Colorado, there are like 230 listings, and there are 400 realtors. I mean,
Well, I saw a chart the
so,
other day that nationwide, there are now more realtors than listings.
and I think what you're going to see, so out of all of this comes innovation or change. The problem is, because we're government run, and because we basically report to the government, and the government makes money, they tell us what to do pretty much. I mean, affordable housing has always been a passion of ours in the industry, right? We all want to do this. So if you do affordable, then in most cases you have to take risk, because the affordable customer needs DPA, down payment assist, and they're a first-time home buyer, and that's a risky deal. So
Okay,
I'm at 95, 100 LTV, and I'm a NewCo person. I've got my first job or whatever I've done, right? So when you see, and you saw what happened in California with CalHFA, if CalHFA had any money, what happened? That freaking money was spent in like 2 seconds.
Yep.
So I think what the government should do is provide tax credits and incentives for consumers to do this, and the private market should probably do it with the government guarantee, but that's not the way it works, right, in America today.
Okay, so just want to make sure that we're clear, because I shared with you that when we go to Washington, DC and Sacramento, when they start talking about affordable housing, I make sure they clarify what they mean. And half the time when you actually put them on the spot, Kevin was there the most recent time that I did this, and it was literally here at the headline. She had no idea. And then
no answer for it.
No answer. What does affordable housing mean to you? That's how I say it. And the answer was no answer, because they throw it around. It's this big, but it depends on who you're talking to. It can be in homeless, housing for the homeless. It can mean rentals. It can mean whatever. So it sounds like from what you're talking about, it's low down, getting people into houses, not building affordable housing, right?
Well, it's also, so if you are going to provide an affordable house, let's just really get this down, right?
Yep.
It would be a modular house or a manufactured house, because it's about 50% cheaper.
Yeah.
Okay.
And, oh, by the way, you put it on a place that has a lot that's over here that has water, which is cheaper. So if you're going to build affordable
west
housing,
of the Rockies,
well, you're going to, like in California, it would clearly be not on the coast and probably not Nevada. So somewhere between Nevada and there, right, there's plenty of space.
But jobs.
How you do it, and that's why the hottest markets in America are Intermountain, right? It's outside of California, from New Mexico on up, right? Really. And you see that corridor, what do they have? They have jobs, they have water, right? They have space, and they have builders and affordable housing. And it's 30, I mean, think about this today. 35% of last month's production, 35% was new homes.
okay.
Never in the history of mortgage have we ever had 35% of our market being newly constructed. And, oh, by the way, we are so far behind in new construction.
Right.
So you want to build affordable houses? Then why do we restrict condos, townhomes, modular, all these other things? Those are affordable houses, you morons.
Okay.
The affordable house isn't the house in California that's it, although it could be if you pick your poison. Like my kids live in Manhattan Beach. Okay, an affordable house in Manhattan Beach is $1.3 million.
Yeah, no, I say this all the time, that California actually has more affordable housing than anywhere else, because for every house that goes on for sale, there's 20 offers on it. That means 20 people can afford that house, versus when I was talking to people in Alabama, they only get 3 offers on their houses. Their houses aren't as affordable, even though they're a whole lot cheaper.
Okay, and I'm going to argue that there isn't water in all those places in the middle of the Rockies in here. Like, water is a huge issue, and nobody's talking about it. And I was just listening to a couple weeks ago, they were doing an analysis of the commercial market in the Silicon Valley, which I mean, if you're in California, you know what that is. It's around San Jose and Santa Clara and up to San Francisco. And the guys who were building the affordable housing, those condo units, they don't want to do them anymore. They lose 30 to 40% on each unit that they're building. So what they're doing is they're going and finding already built properties and they're trying to rehab them and try to make something out
Well,
of.
why wouldn't, I mean,
exist.
look, I've funded ADUs, right? I have
Right.
United Dwelling. I have companies that we've tried, right? So if you, like you said, I think if you took housing, the cheapest way to build units or things for housing would be to take existing and make it work. So you take detached garages and turn them into units, and you take parts of your house. I think probably the number one thing that's going to change in America over the next decade is our view of this and how we use our single family home, because it's going to be used for rental, roommate, families coming back, kids coming back, parents living longer. It's going to be used for just normal housing for family, and it's going to be used for business because your office is going to be in there. So you tell me, a single family home has multi-uses.
Yes.
And that is not, the guidelines are pretty restrictive, right? The agencies only want owner occupied single family loans.
Right.
So when you move to non-owner, second home, I mean, I live in 3 places. I couldn't tell you which one's my primary home, right? So, and if you have other properties, right, who knows?
Right.
But at the end of the day, I think, like, the good point, why restrict lending to those types of housing? And you have to take a more view. If you look at non-QM underwriting today, the biggest pickup in non-QM underwriting is DSCR, right? And I actually think if you look back at my guidelines back in the day, back in 03, 04, 05, 06, 07, and 08, fully documenting loans, bank statements, roommate income, rental income are all hallmarks. And so when you look at DSCR is just rental income, you moron.
Yeah.
Right? So how,
Hello.
and now we've got an industry around fix and flip. We never had that before. So now you've got a bunch of capital and they're eating up single family homes. So I think what you have to do is my personal view of is you got 2 types of consumers. You've got consumers who can afford income, and they have income and they can afford a payment. And then you've got people who have asset but no income, because the reverse business, equity sharing, and all of those things are balance sheet discussions for consumers who don't want a payment but have a great asset.
Right.
And I think today, if you rolled out equity sharing, which we're trying to, but if you rolled out equity sharing like we have in over 62 in reverse, and you said to consumers, okay, if you have a $500,000 house and you owe 200 and you want to take 100 out and you don't want to have a payment, I'm going to find you an investor. Here's $100,000. You got no payment. Now that investor is going to share in the equity with you above that. And I think that's good for you. I think it's a partner, not a lender. I think in foreclosure, default, and all those things, it's better for the consumer, and they don't have a payment. Why don't we do that? Well, that's not what the government does. The government does income underwriting, right? And they talk out of both sides of their mouth about affordable housing, because in order to do a first-time home buyer, you have to be aggressive in income. You have to be aggressive. You have to lower your credit expectations, most generally. And if you're trying to help people of color, first-time home buyers, then you have to be down payment assist. You have to have leverage, because they don't have any money. Forget the issues that we've got in the world today with we don't have any listings. That's another problem. But if homeowners would move or be able to do something, what did we see today? They're 2.5 or 3 times less likely to move when their interest rate's below 4. Well,
Mhm.
no shit. I
Yeah.
mean, I wouldn't move either, right? But if I knew I could go find something, I would move, but I don't.
Right.
So that stalemate has to have a lot of stuff into it, right? You have to have new construction, you have to have affordable housing, you've got to have a move up buyer, and you got to have lower interest rates or ways that people could actually buy something. And it's a interesting time. I mean, I've been doing this for 40 years and I would have said I've seen it all. Well, I was wrong.
You've never seen it all.
I've
ever.
never seen anything like
That's why we love
COVID.
the mortgage industry. It's always something new.
I know.
It's so fun, but
Yeah.
it's so perverse.
It's
in that
crazy.
and yet I think like where Audrey started, right? The government's a blessing and a curse.
Right.
And living in America, I'm not going to throw Fannie Mae and Freddie Mac and Jenny Mae under. They've basically provided us with an industry
Yeah.
and provided our consumer with a really safe loan. The challenge we have is that the guidelines and the rules have not changed.
Yes.
And the regulators almost force this layer of what I'm going to call, well, I guess for one of anything else, it's just cost and regulation to try to deal with coming out of 06, 07, or 08 to try to make it safe again. Well, it was always pretty safe. You can't do loans to people and not qualify them.
But I think that
Right.
there is something.
You need income.
We were talking about this, back in the day, World Savings, like them or hate them, they had a good product for the right person. And I'm not saying we should go back to neg ams at all, but I am saying that those loans that you did, 20% down payment with no income documentation, no FICO scores, by the way, no scoring at all. It was literally, okay, if you have, if you're paying your bills, are you going to pay this bill? And so we've lost track completely of, are you going to make your payment? That, in my opinion, should be the primary question and answer that we are doing on any loan. And we've lost it. It's literally,
we have, but
have you met the
you're
guidelines?
never going to get that genie back in the bottle with the agencies, because they're all about, like you said, affordable housing, first time home. You can't talk to Fannie Mae and Freddie Mac anymore with the world that we're in today, with them not talking about their mission, and this is what they're going to try to solve for, and this is what they're going to do. Well, it's funny. They restrict everything that could help the people.
Right.
Everything. So it's like, all right, if I'm going to try to solve it, I have to solve it by myself trying to get ADU guidelines approved, trying to push more into owner occupied, non-owner occupied, how do you actually look at the single family home, look at the consumer a little bit differently? And I'll try this on for you guys. So out of 30 years of study back on all of our loans that we did at First Franklin, Ownit, today at Skyline, and you look at Finance of America, when we look at our borrower, we basically said there are, and I'm going to distill this, there are 2 types of borrowers. There's mass non-affluent, MNA, and then there's affluent, right? And we defined that.
Yeah.
A mass non-affluent is under $100,000 in income,
Okay.
and under $100,000 in current assets.
Okay.
Affluent is over 100,000 and over 100,000 in assets. You should have, and we did, 2 sets of approaches of how you underwrite an affluent borrower and a non-affluent. But if you're the government, you can't do that.
Right. Or won't do it. So what year was that? I mean, when was $100,000 affluent? Now you're
still is. No, it still is, because you guys got a jaded view because of where you live.
Yeah.
If you're in Minnesota, you make $100,000, you're like a king or a queen. Come on.
Okay.
Yeah.
So
the housing cost
in San Francisco.
It's 190, not 1.9 million.
Yeah.
Right. So I think when you have to look at, so what the government tries to do is it tries to take America and create a a market for it. And you're seeing, look, I've never seen, when I started, I think the conforming loan limit was 93,000. It's almost $1 million. But at the end of the day, what do we don't, I think the point would be what Fannie Mae used to say to me in the days of Frank Raines and Jim Johnson and some of the people, one of the coolest statements that they ever made was that we have to customize the 30-year fixed rate loan so that it fits consumers. So we need to customize the guidelines so that it fits a consumer. And we don't. Our guidelines are, all of us are trying to jam the customer into these old guidelines, and it doesn't fit. Versus if I was a teacher and I had 3 months off, then I should see, okay, I need to add your income for those 3 months. What are you doing for those 3 months? Oh, I'm painting houses and I make X dollars. Oh, I'll add that. Nope, not how it works.
You didn't do it 2 years in a row. You keep.
You haven't had 5 years. You haven't experienced it. You're not a painter. And then they start judging. And then God help you if you own real estate. I can't even use that as an asset.
Yeah, that's
crazy. Not a liquid asset. Are you shitting me?
It hasn't been that
long. It's more liquid. It's more liquid than my deposits at Silicon Valley Bank. Right? So quit telling me what is an asset and what isn't. And if I have Bitcoin, God help you, right? Or you have, so.
How about you're self-employed, but you don't have a Yellow Page ad? It hasn't been that long since I've had an underwriter ask me for a copy of the Yellow Page ad. I'm like,
oh, dude, I think underwriters can go off into, it's almost like they're in the hunt for the white buffalo. They can go off into different corridors so fast. And if you have 200 underwriters, you have 200 different views of income.
Yes, 100%.
And it's like, you could send one. I've had loan officers say, oh, I sent one to Susie and it just gets crushed. And then I sent one to Audrey and it's so good, right? It's like, well, you know why? Because nobody, trains people on how difficult it is today, because most of my customers are self-employed and employed at the same time.
Right.
I have that exact loan right now. I got a client that was turned down by a big bank because their debt to income was too high. And I redo the numbers and I'm like, your debt to income is fine. I got a 35 back end. You can do whatever you want. And I think what you get, right, is this, for at least my view of this is equity. So I've managed at Finance of America. We had a big fix and flip business. We had our forward business, and then we also had a reverse business. Today, Finance of America has moved predominantly into reverse. Why? Because I think we could be best in the world at reverse, and we're good at it, right? It's what they're passionate about. When you look at these other businesses, all of that has sort of been in a mosh pit of products. That the other problem, and I don't agree with Dodd-Frank on this, is that the other problem is that products are different. A reverse is much different than a forward 30-year, right? Guaranteed. And an FHA loan is different than a conventional loan. And so I think when you start thinking about compensation, people do what they're compensated to do. And you can't just have everybody making 100 basis points or 200 basis points. So the compensation rules, which are necessary, but you think about that cost. Okay, now I've loaded all of those costs into base pay. I've got to have all of that. You've got to have benefits. A benefit load in California is probably 30%, right? The rest of the world, maybe 20, 25. Then you get sued by everybody because you don't do meal breaks, overtime, right? You don't, and the loan officers don't like it. No. They would rather be self-employed.
Yes, right? We definitely would
deduct things 100%. And do the things that. So I think that we have, in some ways, taken a big step back over the last decade or so. And it's hurting us now as we try to digitize, we try to automate, and we try to do things to help today's ever-changing consumer. I mean, if you look, I think just having, just trying to figure out how an influencer gets paid based upon views. Okay, we never thought about that, right? There was never, and so there's so many component parts that are wrong that you have to start somewhere. And so my view has always been that I'm passionate about helping mass non-affluent people own homes. And so I focus all my efforts. If you even look at my tagline, even in my little towns, I try to help communities grow one business, one person, one home at a time. Because when I try to solve the problem big time, I just rather shoot myself in the head.
Well,
and
that's been a problem for a long time, in my opinion. They've created this one size fits all, supposedly. To your point, there are 500 different ways to underwrite a 30-year fixed, but everyone's supposed to fit in this little box, and the box no longer fits at all, and they won't address it directly. And so we're not going to
get bigger boxes.
Well, so then we have the portfolio products, which are so important and really saving the day these days. But most of us are still so wrapped up in the idea that we should get a conventional Fannie Freddie fixed rate at a really, really low interest rate. And somehow we got to squeeze every borrower into that box. We need to get over it. Like, as an industry, but that messaging also needs to come from the regulators, from the everyone needs to be saying it, and nobody's saying it, because again, rate is our problem right now. And it's not what the actual rates are. It's our mindset about rates, because everyone's like, oh, wow, my God, I have 4%. Yeah, you got 60 grand in credit cards at 29.99%. But if I ask you what your rate is on your credit card, you have no earthly idea, but you sure as hell know that you've got a 4% or a 3% or whatever it is on your mortgage, or you think you know. But because, by the way, when I actually get your mortgage statement, you're usually off by an eighth or a quarter, because you've been lying to all your friends, because somehow that became
I got a good deal
at a dinner table, at a dinner party. And so everyone's like talking about their mortgage rate is, but who gives a crap if you're
I had that
30%?
exact situation this week. I had a client had $50,000 in credit card debt, all around 29%, and she just doesn't want to give up her $150,000 mortgage at 3%. And I'm like, the $150,000 deal is going to sink your boat. 150, you need to get rid of that in order to balance your boat so it doesn't lean and fall over.
So Bill, is there a way to get these portfolio lenders to marry the market instead of just going steady? Because we need them to stay in when shit goes sideways. And if they won't, then how do we fix this? Like, how? Fix it.
You got
Dallas Capital.
In 03. So in 1994, interest rates went up 6 or 7 times, and it wasn't telegraphed, right? Because we didn't have like cell phones and TV like my kids. You actually watch cable, right? Where's my Roku button, and where do I do this? And I'm like, no, do we still have a landline? Do we still get a newspaper? And do we still have cable? I don't know, right? But when you look at our business, and you look at trying to make advances, in 94, rates went up 6 or 7 times. Okay. In October of 93, I was doing $1 billion a month in 30-year fixed rate loans. In January of 94, I did $100 million of HELOCs with RFC. That's how big it changed. So don't tell me that this hasn't happened before.
Yeah, well, back in
what's
those days,
happened,
you switch.
Interest rates at that time go way up. Now, what we haven't seen are interest rates here going way down and then coming back up to normalize to some level.
Right.
So if we're in the 4, 5, 6 rate, right? Those are good rates. They're good rates for savers. They're great rates for us. People have to get used to it, but we have to change the guidelines.
Yes.
And we have to make it easier for a customer. So how do you do that? Well, the only way that I know to do it is to create securities and assets that are non-agency.
Yeah.
And you build a market for those. And you basically do that. And so before, when we did it, it was how we introduced bank statements, how we introduced roommate income, how we introduced DSCR and rental income and other assets. But and then if that is successful, the agency tries to take pieces of it and build it back into its guideline. And so what a challenge with the business is that you sort of push that elephant up the ladder for a period of time, and then the market crashes. And so you get this constant movement, which makes it very hard because people basically have PTSD still about second mortgages. And that comes from 1980, right? So I think we just have to have the wherewithal, and people, I mean, trying to create securitizations around home equity. We're trying to do that today. People are trying to figure out closed-end seconds and HELOCs, whether you're Blend or your Spring EQ or your other companies that are trying to figure it out. So innovation in product comes at times like this, which is cool, right? So I've worked so hard on equity sharing, and I've taken a company from San Jose, Equify, and you've got companies, good companies giving it a shot, right? But they're all direct to consumer companies that came out of Point, Unison, Unlock, HomeTap. All those companies are trying to do it, but it's insurance capital that's coming to mortgage, not mortgage capital that's coming into mortgage, that makes that asset securitizable. We do reverse loan, at Finance of America, you sell the HECMs to FHA, but if you do a jumbo reverse, it's either Longbridge or Finance of America or companies like that try to make a market in that. Those investors are insurance investors who don't need a payment and are willing to invest in and think about this. Most investors around the world want to invest in America's single family home market. So this is as good a time as any. It doesn't get any better than this, right? Because the market for single family homes is flat.
Right.
Home prices are flat to up, and people have got more record home equity. There is not a dent in the consumer yet.
Right.
So now's the time to do it.
Well, and on that, all 5 indexes are now on pace to show 5 to 10% appreciation for 2023. Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow, all of them. They are
5 to 10.
all on what?
5 to
Every
10.
investor, I
5
can
to
say this, that
10%.
every investor in the private market, so whether you're Blackstone, BlackRock, whether you're Apollo, you're Athene, you're Bain, you're Warburg Pincus, you pick them, right? You can go then to the streets like Goldman Sachs, Merrill Lynch, B of A. They all are basically saying that we're flat to up in home prices.
Yep.
And that means, and there is, if you think about that, there's no way home prices can come down when there's no inventory.
Right. The
Because
demand is huge.
Like Kevin said, how many offers are you going to get when there's no houses?
Yes, exactly.
A lot.
So,
right.
And by the way, those new home sales, those signed contracts in June, we're on a 697,000 annualized pace for new home sales, 24% year over year, but a huge percentage of those have not even been built. And so it's a problem because so they're signing contracts, but they're not done yet.
Well, and when I look at, so I go back to your listeners and to you guys and say, okay, I think the thought process of one, I need to help you free up home equity so that people have a couple different shots of pulling equity out. If we do that on a rational basis, right, people will begin to move, right? I think on the other side, if I was pushing the government, I would say you've got to really allow broader than a single family home. So you've got to redefine SFR. And you've got to allow for the odd structures, co-ops, townhomes, condos, ADUs, modular housing, manufactured homes, because that is affordable. So go ahead and do that. I understand it's a little risky, right? But I'm not talking about doing a duplex. But look, I mean, we're going to probably spend $1 gazillion in America taking the inner city business structures of all these main offices and turning them into housing. So
that's not going to work.
Have you guys ever tried to do a co-op in New York City?
I've done it in San Francisco.
They're a freaking
brutal.
nightmare. Oh,
Yeah.
Do you have it all sold? Do you have pre-sales?
Oh,
Do you
we
have
know.
one? What's the single family? I mean, it's like, by the time you're done trying to underwrite a condo, you want to shoot yourself in the head.
Oh, trust me, we're well aware. And by the way, HOAs not regulated. They are out of control.
I don't know. I have someone leaving their HOA right now because they can't stand. They're giving up. They're 2.5% interest rate.
HOAs are suddenly costing you like
They're a huge
more than the house
problem and
payment.
not regulated. Not regulated, Bill, in California. Like we've asked the DRE commissioner. Yeah, nobody really oversees them. And they're all run by a bunch of people with an extra time on their hand who are willing to be on board and
it's like
qualifications.
it's like the local militia. It's run by it's like a Revolutionary War thing where you got 12 people who are suddenly in charge, right?
Yeah,
and they're going to shoot the rest of you, right? And
or the other way around.
What do you
do? Nothing.
No lie. So I think when you start, it's an underwriting problem, really, right? Because the challenge has to be that we have to rethink the custom. And I would come back to your listeners and say, look, let's talk to people about customizing the guidelines so that they fit, so that you can sort of take little component parts that fit a single mother, a single man, a single family. When you see guidelines, it should be encouraging to try to gather income for you, not restrict it. I mean, can you imagine? Well, I mean, do I get if I am a single parent, I probably am either collecting on my any of my child support, alimony, anything else. Oh, guys, you try to count that? I mean, it's a nightmare. So I think we have to focus more on bank statements, right? Because that's easier. And whether it's 1 month, 12 months, I don't care. But income, when you're a first-time home buyer, your income is going like this. That's why you're buying the house. Now there's chances I get fired and all of that, but I mean, you're still making loans on single-family houses that are good, that 99.9% of the time go up in value.
Yeah.
But the problem is, like, bank statements are good to a certain degree, I think, but they're also part of the problem when you have a lender who will look at them and go, oh, wait, we're now going to count your pet insurance in your DTI. That happens. Or we're going to, what about this expense? What about that expense? It turns into another nightmare for the borrower. And so, again, I feel like if you have that much equity and it's stable and you've owned the house for 20 years, why do you need to even document your income for a refinance on a 20%? Or if you've got
we had this at Finance of America. My underwriting team was pretty cool. So I said, let's innovate this. So what I want to do is I want to throw out everything we know about what we just talked about.
Yep.
Right. And you guys have seen a lot. So these are just my underwriters and my regionals and my operations teams and all those. And so I said, here's what I want to do. I want to innovate this. So if you guys had the pen and you could do, how would you do this?
Mm-hmm.
And this is really interesting because what they came back with was the best way to underwrite a customer would be to take what VA does. And they would say that we just think you should have residual income.
Yes.
Above a payment number,
yes.
Not a ratio, not anything else. And we like that. And I went, wow, that's actually pretty compelling. And then I could have a different level of leftover income
Yes.
for mass non-affluence, affluence, if they got a lot of money left over. I thought, wow, I haven't even thought of the residual income approach versus DTI and everything. Because now we get all wrapped around the axle with DTI.
Yes.
I mean, DTI has never been proven to be correlative to default. So listen to me.
Right.
Never. So what's correlative to default is you lose your job.
Yep.
That's pretty correlative, right? So
And
if you
could have
lose your
some kind of
job,
insurance on that.
you could have insurance, your FICO score. That's why everybody went to FICO, because FICO pretty much if I looked at Kevin's FICO, it tells me the story of you being able to manage that.
Uh-huh.
Yeah.
Better than job, right? So, and you're reemployable or you're going to get income from somewhere, blah, blah,
Right.
blah. Right.
So
So
in the tech world,
I
you
think,
got 3 full-time jobs.
yeah. And I mean, people figure that out. And another thing is I own the largest fraud detection business in the space. Right. And yeah, the 40% of all fraud in mortgage is occupancy.
Yep.
And then there's
Both
probably the
ways.
balance.
Both
The
ways.
balance is combination of income and assets, right? Generally income, because people are lying about their income.
Right.
Well, at the end of the day, if we made it easy for you to actually provide me with the stuff, and we were figuring out ways to do it based upon your ability, because it can't just be your ability. I mean, we use these words like the ability to repay and DTI and things like that. I think we've lost our way a little bit.
Yes.
We need to have, you don't lose money and you generally don't default if you have assets.
Yeah.
Right? Because you can use other assets to pay it.
Yeah. And oh, sorry, Bill, go ahead.
No, the riskiest part of mortgage is the part that the agencies are focused on.
Right.
And so over time, they've just continued to take that funnel. And we talk a lot about affordable housing, but by the time we get to actually your borrower, it looks like unaffordable.
Right.
Because I can't qualify. I don't have got it. This doesn't fit.
Exactly.
So I think there's timing differences as well. There are times to be aggressive in mortgage, and then there are times not to be aggressive in mortgage. This is one that it's time. You've got home equity, you got home prices going up, you have the world sort of in a good spot in America. Like Audrey said, you've got all your indexes going up. Could we be in a recession? Could we go the other way? Sure. But we're not going to ever control the macro market. All we can control is what we do every day. And housing is extraordinarily safe in America, almost all the time.
So I think that is very fascinating because the SLOOS survey came out, senior loan officer, I think opinion survey. It showed a slowdown in credit contraction, right? So less lending, tightening guidelines, right? CoreLogic's loan performance survey came out. 30 days went from 2.8% to 2.6%. 90 days went from 1.3% to 1%. Foreclosures remain at 0.3%, which these are all historic lows. And so we have so you're saying that this is the perfect time. We have equity. There's plenty of equity. And meanwhile, and all the delinquencies way down, nobody's losing their houses or very few people. Meanwhile, we're contracting credit. So we're going the opposite direction that we should be going. And again, we're doing buybacks from the GSEs on loans that have been performing for 18 to 24 months already. I mean, the world is upside down, and I keep talking about it because I'm hoping somebody will be listening and be trying to fix this because it drives me insane. So we have a comment here from Leon Hunting, who is a past president for the California Association of Mortgage Professionals. I figured you might know him. And he said, our biggest problem is that the legislators, their housing aides, government policymakers, and regulators know close to nothing about housing and housing finance. He recently went to Sacramento and met with 26 housing aids, and they knew nothing. And the same goes for us when we go. It is they don't know what they're legislating.
You know what's really funny is when you go to Sacramento, you talk to these aides. Most of the time they start asking you questions about, oh wait, I could buy a house.
Yeah. Or no, most of them have never owned a house, never
Oh,
gone.
no, never have.
No idea.
And they don't believe they
No idea.
can.
Yeah.
Yeah.
So, and
It's-
that's another fallacy. You know, you can buy houses. Otherwise, we wouldn't have, I mean, more 25-year-olds bought houses than in this cohort, in the Gen Z cohort, than in the millennial cohort. And I think the Gen X cohort too. So at the, you know, they measure this, which I didn't know this until this year. They measure at the age of 25, you know, who's buying houses and how many. Gen Zers are buying houses. Maybe not all of them in California. Maybe they're all in Utah. I don't know, but it is definitely happening. So
Well, and I've told you guys, I think I've told you the stories before, right? I have 5, you know, millennial, Gen X, Gen Zers, right? 5 kids, 4 boys and a girl, all own houses. And one of the things that, and they're all young, right? So how do they, and it's important, the earlier you can get them in, the more my personal view is the more they understand how to fix things, the more they understand the reality of taxes, the more they understand the reality of snow and the snow removal and
and
maintenance and utilities and insurance. And at the end of the day, the way we got them in was that every home that we tried to buy is income producing as well.
Mm-hmm.
Right? Because the other thing I tell them is, look, you're a new employee, you're a new job. You don't know, you can get fired in 2 seconds or the world changes.
Yeah.
So why don't we buy something that we could rent the downstairs or a room, you rent it. Now you're making, your mortgage payment is made by a tenant who works all month to make your mortgage payment. I like that strategy.
Yes, 100%. I would take
And-
that over.
And then the
any-
challenge is our income guidelines don't allow it.
Yeah.
Right. So I think we can rethink how we take income and make it simple, because part of the cost to produce and wrap the thinking up, part of the challenges are just income has changed dramatically, because base income used to be how I was paid. And today I get a low base and I get some performance thing, overtime, bonus, whatever. And then I've got another job and I've got a side hustle and something else. And so to the extent that we could figure out how to add income streams, we can help home buyers buy, and it fits the side hustle of, look, I manage with Jason Mattiato. I manage one of the largest Black and brown lenders in the United States. And one of the things that we are passionate about are changing guidelines and changing rules that fit that demographic.
Yeah,
And
so
if
they
you
can
don't
buy
do that.
mixed use.
Well, what
Yeah,
if
I mean,
They're
What if we
big
could
buyers
just-
of mixed use properties, and that you can't do on Fannie Freddie.
and they don't default, they stay in the home forever. The families stay in there. So I think we just there's some, look, we need to make some tweaks. Now's the time to do it. Part of what I try to do is to actually be at a level where you can securitize it or work with insurers or work with the industry to actually make the changes, because like I'm passionate about ADUs, affordable housing, making sure modular, manufactured, and all these other things sort of fit. Yes, I understand that HOAs are, like everybody said, they are fucked up. They're terrible. You look at a condo I mean, all you gotta do is have one condo project that falls completely to the ground in Florida and all hell breaks loose.
No, so everyone else is
Everywhere.
bad. Yeah.
Right?
Well,
So-
I think they were one of a bunch of problems, but I get your point.
They're old properties.
Yep.
Right, are problematic.
That have been
And so-
mismanaged by a board that doesn't know what the hell they're doing.
And then they ask you for, can you give me a statement of insurance, and can you clear this? I mean, it's
I
like
know.
underwriting an HOA or underwriting a condo project is worse than underwriting the borrower.
It's
Right.
100%. 100.
But if we are affordable, if we're pushing that, we have to make that process easier, better, faster, so that people can buy, because that's the most affordable property for them.
Yeah.
Right.
Well,
And like I think when you first start doing it, with what Kevin said is important, because I think if you take existing housing first, especially in California, and allow people to fix it, help them, even if it's a tax credit, to take a portion of your home and provide housing for another. Whoa, wouldn't that be? Now, there would be a lot of fraud because people cheat and lie and do all the things they normally do. But at the end of the day, you can solve some of the issues, right? And I don't mean you have to go down and pick a homeless person up and put them in your house and, do whatever you're going to do. No, I just mean you've got to provide housing. And if there was some incentive for us to do that, I bet you we would do it.
Yep. One of the things I like about you, Bill, is that, and we don't
Only
have to
one?
agree on, I said one of the things, God, don't be so sensitive. One of the things I love about you is that you are thinking outside of the box always. And so whether or not every idea is going to stick to the wall is less important than throwing them and having ideas that expand and make things better potentially. And so I want to challenge everyone that is listening to do the same thing. And one of the reasons that we have people like Bill on, who is a thought leader, who is been in it long enough and been successful enough that people actually listen to him, is we need ideas. So you be thinking about it. You're on the ground with your clients and you know what's going on out there. We need everyone to be part of this solution. So we are out of time. And it's very important that I mention that more monopoly money is printed than actual currency each year. So I'm going to leave you with that, while thanking Bill Dallas for being here today.
Thank you.
Absolutely adore you. And we will look
Appreciate
forward
it, you
to
too.
next week or on YouTube next week, Tuesday at 11 a.m. Pacific time. Thank you, guys.
Ciao.
Have a great week.
See y'all.
Bye.